What if the financial markets we trade every day are not driven by chaos, hype, or emotion, but repeating cycles that have existed for decades? Many traders focus on short term price action, reacting emotionally to every pump and dump. But seasoned market analysts look deeper. They study long term structural patterns that quietly guide capital from one asset class to another. In this video, we are going to explore an analysis shared by crypto market analyst Amanex, who draws a fascinating parallel between gold, silver, and XRP. His perspective is not about price predictions or hype. Instead, it focuses on market structure, liquidity cycles, and how digital assets like XRP may now be following the same rhythm that traditional assets have followed for generations. This is not about guessing tops and bottoms. This is about understanding where we are in this cycle and what that could mean for the future of XRP and the broader crypto market. So, why do markets move in cycles instead of straight lines? Markets do not move randomly. Despite daily volatility, fear-driven sell-off, and euphoric rallies, capital tends to follow predictable phases. These phases repeat because human behavior remains consistent over time. Fear forces investors to sell at the worst moments, while confidence pushes price higher once uncertainty trades. Once uncertainty fades, market cycles usually begin with a shakeout, where excess leverage and weak hands are removed. This phase feels painful and discouraging, often convincing participants that an asset is dead. Once this cleansing occurs, the market enters expansion, where prices rise steadily and confidence slowly returns. Finally, the cycle reaches price discovery, where momentum accelerates and valuations exceed prior expectations. Understanding these phases gives traders and investors a significant advantage. Instead of reacting emotionally, they can position themselves based on structure, not noise. This cyclical framework forms the foundation of Amonex analysis. So, how has gold historically set the direction for major liquidity cycles? Gold has long been the first mover in major market cycles. During periods of economic uncertainty, inflation concerns, or geopolitical stress, capital traditionally flows into gold as a safe haven. This early movement often signals the beginning of a new liquidity cycle. Historically, gold experiences a sharp correction before major expansions. These corrections serve a purpose. They eliminate speculative excess and reset market positioning. Once this reset is complete, gold typically enters a sustained upward trend, creating a roadmap that other assets eventually follow. This behavior has repeated across multiple decades. Gold does not simply react to markets, it often leads them. For analysts like Amonex, gold's role as a structural guide makes it an essential reference point when analyzing other assets, including cryptocurrencies. So, why does silver amplify gold's market movements? Silver has always been known as gold's more volatile counterpart. While it follows gold's direction, it tends to exaggerate both downside and upside moves. During shakeout phases, silver often experiences deeper drawdowns, testing investor patience. However, once expansion begins, silver frequently outperforms gold. This amplified behavior exists because silver functions as both monetary asset and an industrial commodity. Demand from multiple sectors increases its sensitivity to economic cycles. Historical data shows that silver's strongest rallies often occur after long periods of consolidation, when market participants least expect explosive movement. Silver's role in the cycle reinforces the idea that lagging assets are not necessarily weak. Sometimes they are simply early in their expansion phase. So, how does XRP reflect these same cyclical market structures? Ammonex extends this cyclical framework into the digital asset space by examining XRP's long-term structure. His comparison does not suggest that XRP will mirror gold or silver in price. Instead, it highlights structural similarities in how these assets behave over time. XRP's chart shows a significant drawdown from previous highs, followed by an extended period of rebuilding. During this phase, volatility decreases, higher lows begin to form, and the market stabilizes. This is a characteristic of a post-shakeout environment. As crypto market mature, assets like XRP are becoming more sensitive to macro liquidity flows rather than hype-driven narratives. This shift aligns XRP with traditional cycle theory, where patience is rewarded after long consolidation periods. So, why is cycle awareness more powerful than emotional trading? The most important lesson from this analysis is not about XRP alone. It is about how to approach markets intelligently. Emotional trading leads to participants to buy during peaks and sell during bottoms. Cycle awareness does the opposite. Shakeout phases feel hopeless, but they prepare the ground for expansion. Expansion phases reward discipline and conviction. Price discovery arrives only after fear has been fully exhausted. Markets consistently favor those who understand transitions, not those who chase momentum. History shows that while cycles never repeat perfectly, they often rhyme. Recognizing this rhythm allows investors to position themselves before sentiment shifts, not after. And finally, my own personal opinion about this is that this analysis offers a powerful reminder that the time in the market matters more than timing the market. XRP's current structure does not suggest instant gratification. Instead, it reflects a market that has already endured its most painful phase. If gold continues to establish direction and silver confirms momentum, XRP's position within this broader cyclical narrative becomes increasingly compelling. This does not guarantee outcomes, but it highlights probability, structure, and patience. For long-term observers, XRP is no longer just reacting, it is aligning. And alignment with macro cycles is where the most meaningful opportunities often emerge. And this finally ends our video. Thank you very much for watching and see you on the next one.